Good afternoon, everybody, and thank you, Michael, with a big smile. I don't know whether I'm the happiest central banker, but I certainly feel the most fortunate. I'm the most fortunate because I live in a wonderful country that's able to deliver a remarkably high standard of living to most of its citizens. I think it's easy to forget that as we deal with many of the challenges that we deal with. So here in Australia, we're served by strong public institutions. We enjoy a high standard of living, good public services, and we're incredibly fortunate. And I think, as we heard right at the beginning, we've got the lowest rate of unemployment in 50 years. We're fortunate here. And I feel fortunate to be the central bank governor. So once again, thank you for the invitation to address the Economic Society of Australia here in Queensland. This is the fourth time that I've had the honour to do this, and it's a really great pleasure for me to be back in Brisbane. Just a few months ago, the Australian government released the findings of the independent review of the Reserve Bank. Since then, the Reserve Bank Board and the Reserve Bank staff have been working through the recommendations and their implications. Today, I would like to talk about where we're up to in that process and some of the changes that we're planning to make, and then I'll finish with some remarks about last week's monetary policy decision. The review of the Reserve Bank rightly concluded that Australia's current monetary policy framework is fit for purpose. The core elements of that framework are a central bank with operational independence and a flexible inflation target centred on 2 to 3%. In my view, and that of the review panel, these arrangements have served the country well and they should continue. The review also concluded that the RBA has a very dedicated staff who are focused on serving the public interest. The Reserve Bank staff are skilled and professional, and they carry out their work to an extraordinarily high standard. The RBA is also very highly regarded internationally, something that I hear often when I travel overseas. But as times change, we need to change too. The world we're facing is increasingly complex, and it's been right to re-examine how we take and communicate monetary policy decisions and how we're managed internally. So the board and the bank staff have supported the review process, and we've been working constructively through the recommendations. Broadly speaking, the recommendations cover three general areas. First is the legislation that the RBA operates under. The second is how we undertake the monetary policy decisions and how we communicate those decisions. And the third element of the review is how the RBA is managed internally as an organisation. The legislation is a matter for the Australian Government and the Parliament, and the other two areas are largely matters for the board and the bank's management, so that's where I'd like to focus my remarks today. At its recent meetings, the board has spent time discussing the review's recommendations, particularly those that relate to monetary policy decision-making communication. As a result of those discussions, we've decided on the following changes. First of all, from next year, the board will meet 8 times a year rather than 11 times as is currently the case. 4 of those meetings will be on the first Tuesday of February, May, August and November, and the other 4 meetings will be held midway between those meetings. The exact dates of the meetings for next year will be published soon, and we'll publish dates for future meetings well in advance. Second, the board meetings will be longer than is currently the case. They'll typically start on the Monday afternoon and then continue on the Tuesday morning. The outcome of the meeting will still be announced at 2:30 on the second day, typically a Tuesday, as it is now. Third, all board members will have the opportunity to attend an internal staff meeting some time before the actual board meeting itself. This will allow the board members to hear directly from and ask questions of a broader range of staff. Fourth, the post-meeting statement announcing the decision will be issued under the name of the board, not, as is currently the case, the governor. Fifth, the governor will hold a media conference after each board meeting explaining the decision, and the media conference will typically be held at 3:30 p.m, an hour after the decision. Sixth, the quarterly statement on monetary policy will be released at the same time as the outcome of the board meeting, rather than on the following Friday, as is currently the case. Given this and the other changes we're thinking about, we're reviewing the structure of this quarterly statement. Seventh, the board rather than the governor will be the signatory to the statement on the conduct of monetary policy, which is the document that records the common understanding on monetary policy between the government and the RBA. And the new statement is expected to be finalised later this year, and we're currently working on that. Eighth, the board will oversee the bank's research agenda as it relates to monetary policy and aspects of financial stability. And ninth, the bank will continue with its current approach to climate change analysis, focusing on the implications of climate change for the economy, inflation and the financial system. And 10th, the board will work with the Treasury to undertake 5-yearly open and transparent reviews of the monetary policy framework. Together, these changes are significant and they represent a substantial response to the recommendations of the review. The less frequent and longer meetings will provide more time for the board to examine issues in detail and to have deeper discussions of monetary policy strategy, alternative policy options and risks, as well as on communication. And likewise, the staff will have more time for analysis, with less time spent preparing summaries of recent developments. The board will also be able to hear directly from more staff, and they'll have greater opportunity to request work on particular topics. And the post-meeting media conferences will provide a timely opportunity to explain the board's decisions and to answer questions, and it will complement our existing approach to communication, including speeches like this with Q&A. Together, it's a significant package of reform that will contribute to better decision-making and communication. The review also made a number of recommendations that, in the board's view, are best considered after the legislative process has been completed and a new monetary policy board is up and running. This will avoid the current board locking in a future board into a particular approach. So there are 4 recommendations that we think are better dealt with by a future monetary policy board. These are the publication of an unattributed vote count. The second is all board members making regular public appearances to discuss their thinking about monetary policy. Third is the establishment of an expert advisory group to advise the board. And the fourth is board papers being published with a 5-year lag. These 4 issues are all interrelated. And practices differ across central banks, and they're often tailored to the country's particular circumstances and institutional characteristics. The current board has judged that these 4 issues are best considered as a package by the new monetary policy board. In each of these 4 areas I just mentioned, there is no universally accepted definition of best practice. The current Reserve Bank board structure, and that recommended by the review, is quite unusual by international standards. In almost every other central bank, most of the decision makers are insiders. That is, they spend the bulk of their time inside the central bank. In our case, only 2 of the 9 board members are insiders. That's the governor and the deputy governor. The other 7 people on the board spend the bulk of their time outside the RBA, and that will remain the case if the review recommendations are all implemented. So this is a significant and material difference between the RBA and other central banks. The Australian model has the advantage of ensuring that there's diversity of thought, and it helps bring a wider perspective to monetary policy decisions. But it does have implications for the way those decisions are communicated and the appropriate accountability mechanisms. So in my view, and in the view of the current board, it's right to allow the new board to consider these issues and to make its own decisions after due deliberations. The bank, together with members of the Council of Financial Regulators, has also been considering the recommendations that relate to financial stability. We have agreed to update the MOUs between the members of the Council, and the RBA and APRA will also update their MOU to set out clear and specific commitments regarding cooperation. We've also agreed that it was appropriate for the new Monetary Policy Board, once it's established, to consider the nature of any formal advice between the RBA and APRA. Another issue that the review panel discussed was the management of board members' potential conflicts of interest. Before speaking about this, I want to note that the panel did not hear any evidence of problems in this area. And I know from first-hand experience just how seriously the board members take their responsibilities in this area. Nevertheless, the board has reviewed the Code of Conduct and agreed to strengthen the already strong standards by making it crystal clear that members and entities they control are prohibited from transacting in interest rate and foreign exchange derivatives and from active trading in any financial instrument. These are the same restrictions that have long applied to the bank staff. The board also agreed that the Code of Conduct should be reviewed again once the Monetary Policy Board is established. The overarching principle that the board has sought to apply as its work through the recommendations is that the RBA should be as transparent as it reasonably can in a way that's useful to the community. We want the community to understand what we're doing, why we're doing it, and the factors we're taking into account and how we're managing the trade-offs. The changes that I've laid out this afternoon are a significant step in this direction, and the new board will have the opportunity to consider the merits of further steps in due course. I would now like to turn to the recommendations that relate to how the bank operates internally. These recommendations are very much focused on ensuring that the RBA is an open and a dynamic organisation. The review panel rightly identified opportunities for us to further empower our staff, to provide stronger leadership, to create a more open culture that encourages constructive challenge, and opportunities to make greater use of the staff's technical skills. This all makes a lot of sense, and it's consistent with the changes that we've been seeking to make over recent years. We have made progress here, but the review rightly points out we've got more work to do. We're now embarking on a significant program of cultural change with these objectives in mind. Some first steps including updating the leadership goals that apply to all managers to make it very clear that they're expected to create an open and inclusive environment where staff can share ideas in an open and constructive way. In addition, a comprehensive 360-degree feedback process for all senior leaders will be introduced in the year ahead, and we're exploring deeper and more consistent leadership training. We've also begun advertising more management vacancies externally and will increase transparency around internal opportunities. And as part of this journey of cultural change, we're also reviewing the internal processes and structures that support the board's decision-making. The review recommended that we also appoint a Chief Operating Officer to help achieve the objectives of being an open and dynamic organisation, ensuring that we're as efficient as possible. This recommendation also makes sense to us. The bank has become a more complex organisation over time, and standards of good governance have continued to rise. And we're currently working through the appropriate span of control and reporting lines of the Chief Operating Officer, and we will begin a search process for this role later this year. In related work, we're reviewing our risk management framework and seeking to embed the 3 lines of accountability model more thoroughly across our organisation. This work was prompted not just by the RBA review, but also an external review we commissioned after a major technology problem we had last October. In response to the technology outage, we're undertaking a major body of work to uplift the operational resilience of the nationally important payments infrastructure that the RBA operates. The review also recommended that we elevate the communications function within the bank. We're also proceeding with this recommendation, and we will establish a separate communications department. This new department, amongst other things, will provide strategic communication advice to the Governor and to the Board. And it will also bring the various communications activities together under one roof, including our education programs. And we will soon start the search process for an executive to lead this important function. Together, these various changes that I've spoken about represent a substantive and meaningful response to the RBA review. They will enhance our decision-making and our communication, and will help us be the open and dynamic organisation that we aspire to be. We're very conscious that we have an important job to do on behalf of the Australian community. The bank staff are committed to doing that job to the highest possible standards, and these changes will help us do that. The review also includes some other recommendations that I haven't had the opportunity to speak about today, but we're working through those and we will report progress in due course. I would now like to turn to the Reserve Bank Board's monetary policy decision last week. As you know, the Board decided to hold the cash rate unchanged at 4.1%, and this decision will provide the Board with more time to assess the state of the economy and the economic outlook and the associated risks. The decision to hold interest rates steady this month follows a cumulative increase of 4 percentage points since May last year. As you know, that's a significant and it's a rapid tightening of monetary policy. This tightening of policy is working to establish a better balance of supply and demand in the economy and to bring inflation down. It's also worth noting that central banks in most other advanced economies have also been increasing interest rates for exactly the same reasons. So Australia is not alone here. The Board is very conscious that monetary policy operates with a lag and that the full effects of the tightening to date have not yet been felt. It takes time for businesses and households to adjust their spending and investment, and there are significant resets of low fixed rate loans to come. Given the lags, economic growth is expected to be subdued over the next couple of years, and it will take time for inflation to return to target. It remains to be determined whether monetary policy has more work to do. It's possible that some further tightening will be required to return inflation to target within a reasonable time frame. Whether or not that's required will depend upon how the economy and inflation evolve. At its next meeting, the Board will have an updated set of economic forecasts from the staff, as well as a revised assessment of the balance of risks. The Board will also have new readings on inflation, the global economy, the labour market and household spending to help inform its decision. Our priority remains to ensure that this period of high inflation is only temporary. High inflation hurts all Australians and it damages the functioning of our economy. It erodes the value of people's savings. It makes it harder for businesses to plan and it makes it harder for them to invest, and inflation worsens income inequality. And if high inflation were to become entrenched in people's expectations, it would be very costly to reduce later, involving even higher interest rates and a larger rise in unemployment. That's the reality we face. It's for these reasons that the Board is resolute in its determination to return inflation to target within a reasonable time frame, and we will do what's necessary to achieve that. Our most recent set of forecasts, which were prepared in early May, have inflation returning to the top of the target band in mid-2025. Data received since then have suggested the inflation risks have shifted somewhat to the upside, and the Board responded to the shift in risk with a further lift in interest rates. We're continuing to assess the central forecasts and the risks, and we will conduct a full review of the forecasts and the risks at our meeting in early August. As part of that review, we'll be assessing the many cross-currents affecting the inflation outlook at the moment. On the one hand, there are ongoing pricing pressures from a number of factors, including the very high level of capacity utilisation in the economy, quite strong growth in unit labour costs, mainly because of weak productivity growth, a big pickup in rents, and higher prices of electricity. But on the other hand, there are factors working in the other direction, contributing to an easing of inflation. These include an easing of the COVID supply chain disruptions, a decline in commodity prices in global markets, and slow growth in aggregate demand, particularly in household consumption. The slow growth in demand is expected to lead to some rise in unemployment and a moderation of growth in unit labour costs. It's also expected to reduce cost pressures on firms and to lead to greater discounting than has been the case over recent times, and this should help bring inflation down. So it's a complex picture at the moment, and there are significant uncertainties regarding the outlook. The Board decided that having increased interest rates substantially, it was appropriate to hold interest rates steady this month and then to re-examine the situation next month. So thank you very much for listening. And Michael, I'm looking forward to the questions. Thank you.
The first question is about two well-known US economists, Larry Summers and Ken Rogoff. Larry Summers, for those who don't know economists, was the Secretary of the Treasury in the Clinton administration and also became President of Harvard. Ken Rogoff was a former Chief Economist of the IMF. So both of these people spoke at the American Economics Annual Meeting this year, the beginning of this year, and both of them suggested that there were demographic issues in where interest rates were going. And they suggested that labour force growth had fallen as baby boomers retired and millennials now dominated the workforce. And because workforce growth was lower, unemployment would remain lower. And because unemployment would remain lower, real short rates were higher. Since then, Larry Summers has suggested that that real short rates would also be high because of the US budget deficit. So do you think we are entering a period where real short rates are structurally higher than they've been in the previous period?
Well, it's a very good question, and the truth is no one can be sure here, but I can tell you that this is how I think about it. The real rate being influenced by the underlying rate of productivity growth in the economy and the balance between savings and investment. So is productivity growth going to be higher or lower in the next 20 years than it has been in the last 20 years? I don't know the answer to that. There are some people who think that advances in science mean that we're on the cusp of a new period of stronger productivity growth, which would mean the return on capital was higher, and that would generate higher returns on investment. So that's possible, but the evidence so far is not particularly encouraging for that proposition, with productivity growth having been weak for a number of years. So the other perspective is the balance between savings and investment, and the ageing of the population in the advanced economies will lead to less saving. So that tends to put upward pressure on interest rates over time. The other consideration here is the energy transition. In many countries, countries need to replace their existing capital stock producing energy with a new capital stock to produce and distribute energy, and that's going to create investment demands as well. So the short answer is no one can be sure, and there are factors working in both directions. Okay. So my second question is again Larry Summers, and Larry Summers gave the annual keynote address in last month at the Peterson Institute in Washington DC, and at the end of that he made the following interesting comments about the communication of monetary policy, the views on monetary policy, and he said, and I quote, "My broad view is that Paul Volcker and Alan Greenspan understood what the Oracle of Delphi understood, which is, if everybody thinks you are omnipotent and omniscient, it is a very good idea to speak vaguely in an oracular way so as to preserve the illusion. And therefore, you should not get engaged in specific numerical targets, and you should not get into predicting your future action and what it is going to be." So my question is, do you agree we'd all be better off if forward guidance went back to being as vague as the Oracle of Delphi? Well, I don't know it should be that vague, but from my perspective, what we're trying to do with our communications is to tell people what we're doing, why we're doing it, the factors we're taking into account, and how we're balancing the trade-offs. So that's our general approach. During the pandemic, we had a different approach, and that was because we thought, well, we were at the time in truly dire circumstances, and we thought the dire circumstances that we faced called for a different approach. And we're explicit about what we thought was the likely path for interest rates, It turned out we were wrong there, but we thought at the time, given the circumstances and the forecast, that was the right thing to do. It's not going to be the right thing to do most of the time, and we've had a review of our forward guidance which talked about our new approach of explaining what we're doing, why we're doing it, and the trade-offs we're trying to manage, and allow every individual to make their own judgments about the likely path of interest rates based on the information we provide. I think that's the better approach most of the time. That doesn't rule out a more explicit approach in dire circumstances.
Okay, so bringing now to the question that was the subject of a competition in secondary schools, economic programs, and it was won by Brisbane Girls Grammar, invented the best question. And so the question runs like this. Since 2022, most advanced economies have been hiking interest rates in a similar pattern to fight inflation. Interest rate changes in foreign economies, such as the US, have an important impact on our inflation and exchange rates. So we wonder, and this is the precise question, how much of an impact do decisions made by other central banks have on Australian monetary policy? End of question.
Yep, it's a very good question. Thank you. I mean, all the central banks are raising rates, or at least most of them, for the same reasons. Inflation's too high. First of all, because of the COVID supply disruptions and because of Russia's invasion of Ukraine, and then more recently because of strong growth in unit labour costs. Strong growth in wages relative to productivity, and that's keeping services price inflation high. So that's a common story across most of the advanced economies, and that's why we're all raising rates. We're not raising rates here because the US is raising them, but we're raising them because we're facing the same general economic situation as the United States. So that's how it works. That there is a potential link through what other central banks do through the exchange rate. Because if the US was to raise rates and we didn't, then the US dollar tends to strengthen, the Australian dollar would depreciate, and that would bring inflation into Australia. So that could, at the margin, influence our decisions, but it's very much at the margin. We're raising rates because we need to, because of our particular circumstances, not because the US is.
There should be microphones moving around the room. If you could signal if you wish to stand and ask a question. Hang on. Hang on, wait a minute. Right.
Back
Gene Tunney.
Thanks, Michael, and thanks, Governor. Governor, what's your latest thinking on this greedflation hypothesis being advanced by the Australia Institute that the inflation is largely being driven by greedy corporations?
I've addressed this before. The aggregate data show that the profit share, excluding the resources sector, which I think it's appropriate to kind of treat them differently, the profit share hasn't risen in Australia. What we've seen is firms be able to increase their prices in line with the higher input costs. So they've been able to pass on the input costs fully and preserve the profit margins. But the profit margins have not blown out. There are some specific firms where you can say that their profits have increased, but by and large they're kind of contained to specific areas of the economy, and across the economy as a whole, profit margins have not risen. So it's not the source of inflation. It's contributed in some cases, but it's not the primary source of inflation.
So we need a microphone to Bradley DeLong, just standing there. Can somebody bring forward a microphone to Brad? Okay.
In spite of my almost unbounded love for my friend, patron, and co-author Larry Summers, I'd like to counterpose to his praise of oracular ambiguity in central bankers something Janet Yellen told me in private in 1999, which was that she thought the decisions of the Federal Open Market Committee in the 1990s would have been vastly inferior had they not felt themselves anchored very tightly to a quantitative specified tailoring. as the Reserve Bank moves forward into its new regime, I think it's clear that it's headed for a way in which the pressures on it, for it to follow Janet's rather than Larry's view of the situation, are going to increase. And it's premature to think about what the consequences of those would be, but I would ask everyone to think about them.
So Brad, I'll just ask you a question then. So the discussion then was about monetary targets. So you support monetary targets, or not?
Taylor rule was almost overwhelmingly in terms of interest rate targets.
Yeah.
You know, there was a small amount of monetary targets, but the way John Taylor had posed its original paper, it was very much in terms of real interest rates reacting to inflation and unemployment. You know, and at least Janet's reading afterwards was that, you know, the Federal Reserve would head off outside the fences, you know, and bounding away into the outback if it had not felt that it had to stay within at least shouting distance of what John Taylor would say next month the interest rate ought to have been.
Okay, understood, thank you. So we need a microphone behind you, turn around.
Hello. Over here.
Right.
Sorry, excuse me, we have a microphone over to your right. To the right. Your right. Over here, thank you.
Over there. Right, okay. So where do we go? Okay, we'll start back over there then.
Canada, UK, New Zealand and USA have all started their monetary tightening earlier than Australia and currently have higher interest rates in Australia. Can you speak on the RBA's decisions thus far to be less aggressive than our partners in our cash rate hikes? And given Australian inflation is higher than most of these countries, is there potential for not just further tightening, but more aggressive tightening as well?
Thank you. It's a good question because most other central banks have higher interest rates than we have. So it's a good question about why we haven't raised rates even further. And there are a number of factors. The first is that nominal wages growth in Australia is still lower than it is in most other advanced economies. At the aggregate level, wages are growing between 3.5% and 4%. In the US, Canada, in the UK, above 5%, in some cases above 6%. So that's quite a difference. A second, and this is related, is that labour supply in Australia has turned out to be a lot more flexible than it is in some other countries. Our participation rate here is setting record highs every month. So that's the domestic population, more and more have entered the labour force, and so the supply side of labour is much more flexible than in the US, where the participation rate still hasn't got back to its previous peak. So there are two reasons why the kind of underlying inflation pressures in Australia are less than they are in some other countries, and it's really important that that remains the case. If we saw Australia in the same situation as in the US, Canada, UK, where wages were growing at 6%, that would have implications for our setting of monetary policy. The other element is we've been prepared to allow inflation to come back to target a bit more slowly than some other central banks. As I said in my prepared remarks, we're expecting inflation to come back to the top of the target band by mid-2025. Many other countries have inflation back to target at the end of 24. We've been prepared to go a bit slower to try and preserve those gains in the labour market that we've got over the last 2 years. It took us nearly 50 years to get back to full employment. You know, we're probably through that, but youth unemployment's the lowest it has been in decades. People have been able to get jobs and they get more hours. So that's a huge economic and social benefit. So we took the decision to go a bit more slowly back to the target than some other central banks to try and preserve that. And I still hope we can manage it. The risk that we run in that strategy is that people think we're going too slow and inflation stays too high for too long, and they think we're not serious and inflation expectations adjust. So I want to assure you that we're deadly serious about this. We will get inflation back to target, And we're going a bit slower than others because we want to preserve the gains in the labour market. If it turns out we can't do that, we will have to take the decision to be tougher and get inflation back to target, because none of the problems the country faces are going to be made easier by inflation staying high. We've got to get inflation back to target. We're prepared to take a measured approach, but there's a limit to how long we can take to get inflation back to target, and we think if we get it back in 2025 and preserve the gains in the labour market, that would be a good outcome for the country.
Question from here.
Governor, my question's actually about the case for going slower. Before COVID, since 2014, for the entirety, I suppose, of your time as Governor, before you became Governor, the cash rate had been below the centre of the Reserve Bank's target band. It had been resistant, or the bank had been resistant to, the inflation had been below the centre of the target band, resistant to attempts to increase it for however many years, since 2014. Since COVID, since 2021, it's been above, and the bank's talking about getting it back down. The forecast is mid-25. Now, this man here, Ross Garneau, raised this question this morning that I want to put to you in his talk to the Economic Society Conference. He said, why should the period where inflation is permitted to be above the target be so much shorter than the period you and your predecessor allowed inflation to be below the target?
Yeah, well, there is a balance to be struck here. Remember, the size of the
symmetrical balance.
The size of the deviation is much. I mean, when inflation was below target, it was kind of sitting at 1.5 to 2 for a while. You remember we've had inflation at 7+%. So there's a difference there. As I said before, we're prepared to kind of allow time for inflation to come back to target. But the balance we've got to strike is to keep inflation expectations contained. If we were to say, well, it doesn't really matter that much, maybe we can take 4 or 5 years, inflation being kind of high, then people might rightly wonder how serious we were. And once inflation expectations start adjusting, firms are more likely to adjust their prices as their input costs go up, because I think, well, inflation's going to stay around, I may as well raise my prices. So the whole inflation psychology shifts. So we're trying to keep the inflation psychology contained. And I think to do that, we've got to demonstrate a clear commitment to get inflation back to target within a reasonable time frame. And I think at the moment we've struck the right balance.
One more question from the floor, but then we should go to the media table, I think. There? Oh, hang on, yes. Okay, at the back.
Mark Ludlow from the Australian Financial Review. I will get to the elephant in the room. Given the Federal Treasury and Cabinet will soon decide your fate regarding another term, would you please, can you assess your views on how you've been in this current term as Governor? And if you give that answer short thrift, which I'm sure you will, I will follow up with a second question about the RBA's narrow dual mandate. Obviously, do you think that it will dampen your determination to get inflation down? Thank you.
In terms of my own position, as I've said before, if I was asked to continue in the role, I would be honoured to do that, and I would continue. If I'm not asked to continue in the role, I'll do my best to support my successor, and the Treasurer has said that he'll make an announcement before the end of this month. So I haven't got anything more to add on that. The RBA has had a dual, actually a tri-mandate, since it was established in 1959. We've long had a mandate for price stability, full employment, and the economic prosperity of the people of Australia. I've been perfectly comfortable with that in my period at the central bank. I think it's the right general mandate. The review endorsed the continuation of a dual mandate with price stability and full employment, and making the welfare of the people an overarching principle of the kind of Reserve Bank. So the change in legislation on that particular issue is not of real substance and won't affect decision making.
Any more questions from the media table? Okay.
At the back. Huh? We're at the back. They're right at the back.
Yeah? Is it? I can't see it, sorry. Right.
Hello, I'm Serene Khan. I'm a final year student in finance economics at Griffith University. Also, it's quite an honour to be here. You've done an incredible job so far in your role. I'm sure it's not that easy. My question is, the changes you mentioned today following the review recommendations were all centred around the theme of increasing efficiency and communication to aid the decision-making process of the RBA. And now we've seen this rise of AI, ChatGPT, and all the big banks, as I'm sure you're aware, have already started employing them in a lot of their decision-making processes. So my question is, what is your thought on how the RBA can employ any sort of AI in their decision-making process?
Well, we're currently looking at, and John Simon, the head of our research department, just here in front of me, is leading much of our work there. So it's new, isn't it? So we're all trying to work out how best to use these new technologies, and I'm sure there'll be opportunities for us, but we're still kind of trying to identify it. Our main technology issues at the moment are operating the nationally important payments infrastructure. Now, I hope everyone knows that you can move money between any two bank accounts in the country in 5 seconds. That goes through the Reserve Bank's infrastructure. So whenever money goes from one bank account to another in the country, it goes through the computers in 65 Martin Place. So our main technology priority at the moment is to make sure that those systems are safe, secure, robust, and protected against cyber risks. In time, John and his team will, I'm sure, come up with opportunities to take advantage of AI.
This gentleman here.
There's someone right at the back.
Thanks. Governor Lowe, you mentioned greater collaboration through the Council of Financial Regulators as one of the review recommendations you're looking to take up and implement. I want to take you back in time. What discussions did you have with APRA and the Morrison government about the removal of the 7% floor on the mortgage serviceability test in 2019? And in hindsight, has the removal of that floor increased risks in the economy and limited the RBA's flexibility in setting interest rates now with the inflation challenges facing Australia?
What discussions we had? My memory isn't good enough to remember the specifics, but we have recently been talking about with APRA with the 3% interest serviceability buffer. And I think that's the right size of the buffer because it picks up not just interest rate risk but other risks that borrowers have. So I don't, this has not been kind of a major topic of discussion over recent times. I think the macro-prudential interventions in Australia, by and large, have been successful. There were restrictions, remember, on interest-only loans and on investor loans. Remember at one point, almost half of the loans being made in Australia were interest-only and many to investors, and was a sign of speculative excesses. And together with APRA, we thought it was the right thing to curtail that. And then the 3% serviceability buffer on mortgages, I think it's the right thing. So that relationship between the RBA and APRA has worked very well, and when the government's been involved, it's been constructive.
So we have time for one more question, which I think...
Michael, someone right at the back has had their hand up.
Yeah, right at the back.
Yeah.
There, please.
Mr. Lowe, Adam Walters from Sky News. This morning, the Treasurer said that in canvassing options for the position of Governor, that he would be giving very careful consideration to the opinions of his parliamentary colleagues. As someone who came through the Reserve Bank to the Governor's role, does it concern you that consideration is being given possibly to the electoral implications of the bank's decisions, and that too much weight is being afforded to the view of backbenchers within the Labor Party?
It's a perfectly appropriate thing to do for the Treasurer to consult his colleagues. Yeah, I would expect him to, and I would hope him to. So that's what he should do, and that's what he said he's doing, and an announcement will be sometime before the end of the month.
Okay, one more question. We've only got 2 minutes left for question time.
Thank you, Governor. This is Swati from Bloomberg News. Had a question on your inflation outlook. You sounded a lot more hawkish on upside risk to inflation in May and June, and not so hawkish on those upside risks in July. Are you more confident that interest rate increases so far are working compared to your confidence level in May and June? Are you more confident now versus the previous 2 months about monetary policy tightening?
Well, I'm confident the higher interest rates are working. Talk to any retailer at the moment, they say spending is slowing, people are trading down to cheaper items and in some cases smaller baskets. So consumption growth is weak, and that's largely because of what's going on with monetary policy, but also the decline in real incomes from higher inflation. So monetary policy is working. The issue is, do we have to do more? And as I said in my prepared remarks, that remains to be determined. It's going to be determined by our assessment of the inflation risks and outlook and what's going on with domestic spending. So we're confident what we're doing is working. The question mark is, how much more do we need to do? And we've got a completely open mind on that question.
I think that's... Do we take one more? Or
if you'd like to, yep.
Okay, just one more at the back.
Lucky last. Mackenzie Scott from the Australian newspaper. We know that migration has proven to be a lot stronger than anticipated. We're seeing that in rising house prices, which comes as a surprise, and rising rents. How is this playing into the RBA's decisions around interest rates moving forward?
It doesn't have a direct influence. It has an indirect influence, though, through a couple of channels. The fact that there are a lot more people coming into the country has eased pressures in some labour markets, particularly in the hospitality sector, because a lot of the increase in the population over the past 6 months has been students, and they often work in the hospitality sector. So our liaison with firms in that sector say it's easier to get workers, and that has taken some of the heat out of that labour market. So that works in the short term to push inflation down. On the other hand, all these people coming in have to live somewhere, and that's pushing up rents and housing prices. We thought housing prices would continue to decline this year, but they're not. In Sydney, they're rising quite strongly again, and that's linked partly to the influx of immigration. So it's kind of, there are pluses and minuses in terms of the inflation outlook. Helping contain wages growth, but putting upward pressure on rents. But the more general point that we talk about at the bank is, if we're going to have a lot more people in the country, which is good, we need the capital stock to support those people. Otherwise, the capital labour ratio declines, and that's bad for productivity. So population growth brings huge advantages to the country, but we need governments and businesses to keep investing to build a capital stock to support a stronger population. And the housing market is the kind of clearest example of that, but there are a lot of other examples as well. So it's a broader issue than just the short-term inflation outlook. It's how do we build the capital stock to support a larger, more diverse population, which I think is in our long-term interest.
Well, thank you very much. That was a very spirited question time.